Hey everyone, welcome back to Corporate Decoder, the place where we decode the corporate world. Today we're diving into GoDaddy's latest quarterly report. It's like peeking behind the curtain to see if their online empire is really as solid as they claim. I've got a feeling there will be some interesting stats to unpack. Buckle up because it looks like they're either making a lot more money or spending a lot less on taxes. So what happened to GoDaddy? Well, overall revenue looks steady, but it's the profit picture and a couple of big risks they pointed out that caught my eye, and that could point to a bit of turbulence ahead. Let's dig in. First, let's peek at the overall health of the company with a glance at the balance sheet from March. It shows what the company owns and what it owes. One thing that immediately jumps out is their cash pile. They've got about 719 million in cash and equivalents. Now comparing that to the end of the previous year where they had almost 1.1 billion, that is a steep drop. Looking at the liability side, their deferred revenue or money they've collected for services they haven't yet provided is at 230 billion, up from 2.2 billion at the end of last year. Overall, stockholder equity is also down from 6092 million down to 99 million. That's a huge drop. But what caused such a big change between the end of the year and this quarter? Let's take a look at the consolidated statements of operations. This shows us how GoDaddy made or lost money over the past 3 months. They reported total revenue of 1.19 billion compared to 1.1 billion last year. Breaking it down, their applications and commerce section brought in 446 million, while the core platform pulled in 747 million. Both of these are up. Digging into costs, marketing and advertising is where things get interesting. They spent 100 million, a jump from 87 million last year, which they needed to get that growth. After all that, we get to the net income, 21 million. However, it was 401 million last year. Keep in mind, however, that this net income calculation is massively skewed because of a one-time huge tax benefit last year. In fact, their provision for income taxes was a benefit this year of about 500,000 compared to an expense of 258 million last year. So net income took a dive, but we need to remember those tax shenanigans from last year. What else caused it? Alright, now let's see what the statement of comprehensive income tells us. This is like the statement of operations, but it takes into account other items like foreign exchange stuff. At the end of the day, the comprehensive income is 189 million compared to 402 last year. Okay, time to check out the statement of stockholders' equity. Here we can really see what's going on with the ownership of the company. Alright, let's break it down. At the beginning of the period, they have 692 million in total equity. But then a massive 65 million was removed from the repurchases of Class A common stock line. That's what brought it down so hard. Now, the cash flow statement, this one tells us how cash moved in and out of GoDaddy's bank account. They made 404 million from their normal business. But they only bought a few million in new equipment, so they weren't spending money on investing. But they then blew 767 million repurchasing their own stock using the same ASR that was mentioned in the equity section, which explains the drop in cash. Okay, now we get into the part that most people skip over, but it's important. It's where they outline some of the accounting rules they're playing by. It shows that most of their revenue still comes from the United States, but international revenue is also a big chunk. Then we got into goodwill and intangible assets. It shows the value of GoDaddy's brand and customer relationships. Note 4 is about stockholders' equity, which we've already talked about. It looks like they use some tricky financial tools called derivatives to protect themselves from changes in interest rates and foreign exchange rates. They do have potential liabilities with various risks that can materialize at any point. They continue to have tax benefits and are paying very little in taxes. But it looks like accumulated other comprehensive income is volatile given their use of derivatives. Now, let's move into management's discussion and analysis of financial condition. This is where GoDaddy themselves explains what happened and what they expect. They highlight that international revenue is up 10%, as is bookings and operating income. However, net income is down 45%, but that's explained with one-time items we mentioned earlier. They chalk this up primarily to tax benefits last year and the large one-time repurchase. And it looks like the fluctuations in foreign currency hurt their profits. Then they noted that there were no material changes in their accounting practices from the previous year. Internal controls and procedures are designed to make sure that the data that they provide to investors are correct to a reasonable extent. And finally, let's look at the risk factors section. This part is important because it outlines the stuff that could go wrong for the company. If sales don't continue, growth could be slow or drop. That would obviously be bad. If they fail to develop and market products and services, they might fail to attract customers. They mention how use of AI is risky due to bias and discrimination, not to mention compliance with new rules. Of course, competition is always a concern. Operating outside the US has a lot of difficulties. It's important to keep in mind, and the ubiquitous cybersecurity and service outages and incidents can happen. Finally, they mention anti-takeover measures which would make it difficult for a change of control, even if it's beneficial. Now, what do I think about all of this? Well, GoDaddy is a mature company now, so its growth is slowing. They are dealing with increased costs from a lot of areas, such as legal and customer care. I do like that they are focused on marketing, as that is important for a brand to remain relevant, especially in such a competitive market. With all that said, it's hard to get excited. The good and the bad more or less balances out to a pretty normal report, and the ASRs are not concerning and signal a sign of confidence in the company. They face some challenges in the face of increased competition and market saturation. So overall, a cautiously optimistic outlook. If you enjoyed this deep dive, please hit that like button and subscribe for more corporate breakdowns. Let me know what company you'd like me to investigate next in the comments.